Welcome back, traders. Let's dive straight into the concept of market structure and its general behavior. The core dynamics driving market movements can essentially be reduced to two primary elements that consistently shape price direction. The first is trending, which covers both upward and downward movement. The second is consolidation, often seen as a sideways, choppy, or ranging market. Think of it as a continuous cycle where price flows through downtrends, uptrends, and periods of consolidation that build liquidity and attract institutional orders. Typically, the market requires consolidation in between transitions from uptrends to downtrends, and vice versa. So, the very first question to ask when analyzing your charts is the market currently trending upward, trending downward, or simply consolidating? To build a clear understanding, let's begin with a straightforward introduction. But before we move on, if you find this valuable, make sure to tap the like button. Oh, and don't forget, subscribing is free. But the strategies I share could be priceless. I'll catch you right after the intro and disclaimer. Let's move on to market structures and then explore the core aspects of advanced patterns. Consider a market structure that illustrates an ideal uptrend. I call it ideal because it's uncommon to find a market trend that perfectly matches this model. Price rarely moves in such a straightforward manner. However, for a clearer perspective on how an uptrend functions, we'll first examine this ideal structure before shifting to a more practical version that commonly appears in real markets. In an uptrend, price consistently creates higher highs and higher lows. Typically, the market breaks prior highs while holding above the lows. An uptrend concludes once price breaches one of the major lows to the downside. For instance, sustaining an uptrend requires that price avoids breaking this significant low. Whenever price pushes through a major high, it forms a break of structure and establishes a demand zone connected to that boss wave. Pinpointing valid major highs and lows is essential, as it allows traders to spot signals for either a reversal or a continuation of the trend. Without properly recognizing these critical levels, one risks falling into traps and trading against the prevailing market direction. The same principle applies in a bearish market. During a downtrend, price consistently forms lower lows and lower highs. In this case, the market tends to break prior lows while keeping the highs intact. Now, let's dive into the specifics of a realistic market structure. This reflects the practical uptrend formation that is far more commonly seen in real conditions. Imagine a scenario where price breaks above the previous highs. This raises a key question. How can we correctly identify valid major highs and lows? To answer this, look at the left side of the structure. Price first moved upward before entering a retracement. The highest point reached before this pullback is defined as the major high. Similarly, the lowest point of the bullish wave that triggered the upward move, leading to a break of structure and a new high, is considered the major low. Together, these 2 points form the major external structures, while any formations between them are classified as internal structures. When price pushes beyond the major high to the upside, creating a break of structure, it signals trend continuation. Conversely, if price drops below the major low, it should be seen as an indication of a trend reversal. The exact internal price activity occurring within the external structure range is less important, as long as price remains above the most recent major low. As long as this condition is maintained, the market is considered to be in a bullish state. After forming a bullish internal realignment, the price then breaks the recent major high to the upside, creating a new major high and low. The newly identified major low is the internal low positioned at the extreme. This point is considered major because it represents the last low formed before price initiated the upward movement that led to the break of structure. You may wonder why this other low is not recognized as the major low. The reasoning is that the extreme low is the ultimate and lowest point before price launches into an upward move. This particular low is significant because it is the key level that triggered the bullish impulse and the subsequent boss. Now, shifting to the bearish scenario, it mirrors the bullish case, but in the opposite direction. Let's examine a bearish break of structure, beginning with a major high that initiates the bearish wave leading to the boss. Alongside this, we also identify a major low, which marks the lowest point reached after the break of structure. These two levels, the major high and the major low, form our external structures. while all price activity that develops between them is classified as internal structures. If price breaks below the major low, creating a boss, it signals a continuation of the bearish trend, just as shown here. However, if price moves above the major high, it should be regarded as a signal of trend reversal. Put simply, the specific internal movements within the external range are less important, as long as price stays below the most recent major high, indicating that the market remains in a bearish state. During the upward retracement, price created a series of internal highs and lows within the trading range. Eventually, it reversed downward and broke the recent major low, pushing further to the downside. The internal high located at the extreme is then classified as the new major high. The reason is that this high represents the last internal peak formed before price launched into a strong bearish impulse, resulting in a new boss. Following this, price retraced again, forming another major low. After generating additional internal structures, price continued its downward trajectory, establishing a sequence of lower lows and lower highs. Now, let's focus on another critical element of market structure, the break of structure, or boss. You've likely come across the term boss in trading tutorials, market structure lessons, and trading guides. For instance, in a bullish setup, boss is often described simply as price breaking a high to the upside. However, in practice, there are specific rules and important details that must be followed to confirm a valid break of structure. Let's go over those rules step by step. A valid boss occurs when price breaks and closes above the most recent higher high with the body of a candle. This remains valid even if price quickly reverses downward after the breakout. In such a case, a new major low and major high are formed, creating a fresh trading range. If price then breaks this newly formed major low to the downside, it suggests a potential trend reversal. This shift marks that price is no longer bullish, signaling a change of character. On the other hand, if price pushes above the recent higher high only with a long wick or shadow, and the candle body closes back below the high, with the next candle's wick failing to exceed the first candle's wick, this does not qualify as a valid boss. In this scenario, that low is considered an internal structure within the trading range, and not part of a confirmed trend continuation. To identify a true reversal signal or valid change of character, price must break the major low at the extreme, rather than just breaching an internal high. Now, let's consider another case. If price breaks the recent higher high with a wick, and the candle body closes below the high, but the next candle's wick does exceed the first candle's wick, then this can be treated as a valid bullish boss. In this instance, a new major high and major low are established, defining an updated trading range. The internal price movements between this high and low are less important, as long as price holds above the new major low, indicating the market remains bullish. Only when price breaks this newly established low to the downside can it be regarded as a valid trend reversal signal, or a confirmed change of character pattern. Now, let's briefly break down the bearish scenario, which essentially mirrors the bullish one. Before applying any strategy or setup in a live account, it's strongly recommended to backtest it at least 100 times. In a bearish market structure, a valid break of structure requires that price breaks and closes below the most recent lower low with the body of a candle. If, instead, price breaks above the newly formed major high, we treat it as a trend reversal signal, indicating that sellers have lost control. Conversely, if price breaks the recent lower low with only a long shadow or wick, and the candle body closes above that range, while the next candle's shadow does not exceed the first candle's wick, this does not count as a valid boss. To confirm a true bearish boss, price must close below the low's range with the body of a candle. On the other hand, if the next candle's wick surpasses the first candle's wick and closes above the low's range, we can treat it as a valid bearish break of structure. At this point, it is necessary to update our major low and major high. As long as price continues to trade below the newly established major high, the market should be considered bearish. Only if price breaks the newly generated high to the upside can we treat it as a valid trend reversal signal, or a confirmed change of character. Having explored the different types and scenarios of break of structure patterns, you should now have a solid grasp of what defines a valid boss. Now, let's move into another key aspect of market structure, mapping the change of character. To identify a valid change of character, the first step is to determine the overall market direction, whether it's in an uptrend or a downtrend. Once that is clear, the next step is to mark the valid breaks of structure on your price chart. In a bullish scenario, imagine price forming a sequence of valid boss patterns. The resulting low and high represent the major structures tied to the first valid bullish boss. As explained earlier, any price activity forming between these two levels is considered internal structure. Change of character patterns can be divided into two categories: minor and major. For example, whenever price breaks an internal low, it signals a minor CHOCH. However, a minor change of character by itself cannot be treated as confirmation of a shift in market structure. Here's a common situation that often traps traders. Many beginners, who fail to properly identify structure, mistake a minor CHOCH as a reversal signal. They assume the bullish phase has ended and see it as the perfect time to go short. Usually, they place their stop loss just above that internal high. But, instead of reversing, the market only makes a shallow retracement before resuming its bullish trend, quickly hitting their stop loss. What these traders overlook is the critical fact that the major low was never broken. Without a break below this major low, there is no confirmation of a structure shift. Entering shorts based on a minor CHOCH is premature and often results in repeated losses. To obtain a valid market structure shift signal, traders must wait patiently for price to form a major CHOCH, which occurs only when price breaks and closes below the last major low that initiated the upward move and produced the bullish boss. Furthermore, it's important to always keep in mind that in a bullish scenario, a change of character is only considered valid when price breaks and closes below the last major low with the body of a candle. If price merely pierces the structure with a long wick or shadow and then closes within the highs range, the CHOCH is invalid and cannot be treated as a market structure shift. The same principle applies in a bearish scenario. For a valid change of character that carries high probability, price must break and close above the most recent major high with the body of a candle. A simple penetration with a wick or shadow does not qualify as confirmation. That's it, traders. Thank you for watching this video. I hope you found this video helpful and insightful. Don't forget to hit the subscribe button and turn on notifications to stay updated with all our latest content. We truly value your feedback and suggestions. So share your thoughts in the comments below and let us know which topics you'd like us to cover in future videos. Your support means a lot, and we look forward to seeing you in the next episode.